All right, welcome to followmetrades.com. Saturday scanning, looking for great trade. I'm Dean Jenkins, founder of followmetrades.com, and I'm excited to be here with you this morning. I think the market's always interesting, but it's getting a little more volatile and maybe bringing us some trading opportunities. We're going to see if we can find some there. So get going here. And again, this is scanning for trades. That's the purpose of this webinar. And you may have noticed that, there's 10,000 publicly traded companies in the US exchanges, and then the ETFs and futures and whatnot. And now there's crypto. Finding great trade candidates can be like, it's like a needle in a haystack, man. There's so many out there, it can be overwhelming. There's so much news. So let's try to make this a little bit easier. See if we can narrow that down just a little bit. My focus is on stocks and options. Right? So let's see if we can find a few of those needles in the haystack. I'm gonna show you how I do it. I'll share the trades that I find, and I'll extend an offer to follow along with me each week at the end. So if you're interested in that, and kind of what we go through here in my approach, then at the end, there'll be an offer to continue. Always there's a disclaimer, right? Everything presented here is for education, information purposes. I am a trader. I am not a financial advisor. I'm not giving financial advice. All trading and investing involves risk, and risk control must be used. And I'm going to show you a real quick snapshot of my basic approach to risk control during this presentation. All right, about me, and I'll turn on my camera for just a moment here. Show you there's a real person behind the curtain here again. So good morning, I'm Dean, founder of followmetrades.com, and it's good to be here. Thanks for carving out this time on a Saturday, and I'll do my absolute best to make it worth your while. All right, so I'll turn the camera off, so that's not a distraction, but I did just want to say hello. All right, so I've been trading and investing for over 25 years. It really started when I was working for Intel Corporation. I joined and give us incentive stock options. We had a stock purchase program. I joined Intel in 1993, and lo and behold, that was right as we were climbing up into the .com thing, and Intel was growing with that. And it split and doubled every 2 years like clockwork. And pretty soon, those options in that stock were worth a lot of money, and I decided I was really good at trading and investing. During that time, I got an MBA from the University of Washington, and I started off as a fundamental trader, using what I learned in business school, analyzing companies and ratios and doing all this stuff. And I got mixed results on that, because it turns out, after you do all that analysis and figure out what should happen, it doesn't happen. Sergio says quite a shirt. Yeah, got to keep it tropical here, man. All right. At one point I got frustrated with trading about 2007. I said, this is too frustrating. I just went to cash, and that was super lucky. I didn't have a crystal ball, because in 2008 the market totally crashed with the subprime mortgage crisis. But I couldn't stay out. I got back in after that crash, because it's like, man, some of these companies were so low priced and, too big to fail, whatever. So I got back in, and I got into some winning trades. Like, I bought Bank of America at like $5, and it went to $12, and a couple others like that. But I was stressed out, because you've probably experienced this. Being in a losing trade is definitely stressful, but being in a winning trade can be stressful as well, because like I said, I bought Bank of America at 5, it went to 12, and you go, okay, it's more than doubled. Should I just take my profit and not give it back? But what if it goes up more and I miss out on it, right? So not having a trading plan, not knowing what to do, can kind of stress you out. I got interested in technical trading, where we just analyze price action on the charts. And like many people, I went looking for the magical indicator, which does not exist. So I made a bunch of mistakes, went down a lot of wrong paths, but finally landed on a pretty solid trading plan. And I credit Bennett McDowell of traderscoach.com. I finally connected with him, and he did some coaching with me, taught me risk management, taught me really how to have a trading plan. And by 2012, I had settled in on the core of my trading plan that I use today. I've made some enhancements, But you know, the real core of what I do today, I learned in about 2012 and started getting consistent results, consistent profits. And then in 2015, I launched followmetrades.com. So I've been doing this for 6 years now, and I really enjoy trading and having folks that I'm coaching and mentoring and customers. You know, that keeps me really sharp, and I learn a lot from my customers and students as well. So that's a quick view of my story. So again, I launched followmetrades.com in 2015. Here's my website, followmetrades.com. There I am. And it talks about, you know, the service and what I do, and I publish results every year. And, you know, running an average between 20-25%. I see my webmaster has not updated the results year to date. We're better than that. And every year, if you can go look at the actuals, you can go click on the button and see the details of every single trade. I believe in complete transparency, the good, the bad, the ugly, right? So if you click on that button, here it comes. There's every single trade I took, win, lose, or draw, right? The details of it and my trading statistics. So that's on the website. So little housekeeping for today's session. You know, please feel free to ask questions as we go. Use the chat box on the Zoom webinar platform. All right, I'm going to explain the setups I'm looking for, because, you know, it'd be kind of weird if I just said, oh, here's a great trade on XYZ stock, and I didn't really tell you why I thought it was good. So I'm going to explain what I'm looking for. I'm going to walk through how I scan for stocks. I use a variety of methods. I'm going to try and find some great trade candidates. That's the goal here. And after I do that, you may have some symbols that you're interested in thinking about. I'd be happy to offer my analysis using the tools that I use. And you know, who knows, you might identify something that looks great. I often get great trades doing this, so it's a two-way street, right? We'll take a look at the trade candidates at the end and some actionable trades for next week. And then I'll extend an offer to you if you want to keep following along on trades I take and participate, and I'll explain more of that at the end. So stay with me if you want to get the most out of it. All right. And again, feel free to jump in and ask questions as we go. I love quotes from smart people. Here's Benjamin Disraeli, right? The secret to success is to be ready for your opportunity when it comes. So we're going to sit down and look for trades, right? We want to be ready. We want to have a plan, have some criteria, and then when we see it, we recognize it and we're able to act on it, right? And Louis Pasteur, in the field of observation, chance favors the prepared mind. Says it all, right? Got to be ready, got to have a plan, right? Here's what I've learned about successful trading on my journey is to be a consistently profitable trader, and you can be. Never mind all those ads and emails and stuff that you've probably seen talking about taking $1,000 and turning it into $1 million in 6 months, right? You guys know that's nonsense, right? But you can make money in the market. You can be consistently profitable and make, you know, good money, good profit, but you need a plan. And these three things are essential. You got to have, you know, trade setups that you're looking for, some kind of criteria for the trade. Those setups have to have a high probability outcome. You got to have a better chance of winning than you do losing. You got to have a good reward to risk ratio on the trade, meaning if the trade is successful, it makes more money than it would lose if it fails. And some trades are going to fail, right? That's a reality of the market. You got to have risk management. You got to control how much you lose. You got to keep the losers small relative to the winners. And you got to have a plan for managing a trade. Right? Once you're in the trade, you need to know what you're going to do. Otherwise, you get kind of paralyzed, right? And I talked about earlier, before I had a trading plan, you know, being kind of stressed out, even in a winning trade. So even in a winning trade, you got to have a plan, and you got to know, you know, kind of have your moves scripted ahead of time before you experience the emotion of being in a trade, which you're going to do, right? It happens. Let me show you a trade we took recently. It's a good example of this. Bring up my chart here on TradeStation. Here's the S&P 500. We'll talk about that in a minute. But here's a trade we took recently that worked out really well. It's Target. Here comes the data. And we went short on target. And you see, we went short on September 7th, right there. And you can see it bobbled for a while. And I'm going to explain these indicators and the criteria in a minute. It went sideways for a little bit. We were patient, and it finally did what we thought it was going to do. And it really made a move down, about a 10% move down. And this green line is where we closed the trade and took our win. So that was about a 10% move in the underlying shares. So if you were just shorting the shares, 10% win is a pretty good deal. And then if you were trading it with options, with the contract that I suggested and sent to my subscribers, we put, based on this model account, $1,780 into the trade and made a profit of 53.90, 303% on that trade. So when I say trade management, that is what I'm talking about, getting the most out of a move on a chart. That was about a 1 month trade, right? But we caught that move and we caught it just right. And we were patient and managed it really well. And I know some of my existing customers are on here, and hopefully you guys jumped in on that target trade, and we're happy with that one. So that's an example. They don't all work out that way, that's for sure. Some lose and some don't make as much, but you gotta have a strategy. So you can, when you get those nice movers, you can really get the profit out of them. All right. Here's the tools I use and some setups I'm looking for. I'll walk through these: Dow Theory, Ichimoku Cloud, Elliott Wave, and then my overriding criteria is high probability outcome, great reward to risk ratio. All right. And I got a couple folks typing in some symbols they want to look at. We'll get to that. We'll get to that. So hold that thought. All right. So Dow Theory, it's one of the tools I use. Charles Dow, he's the guy who founded the Dow Jones Company, and he was also the founder of the Wall Street Journal. And he wrote a series of editorials in the Wall Street Journal in the 1890s. And those editorials are now collected in books and called Dow Theory. A part of Dow, what Charles Dow observed and documented in Dow Theory was definitions of trends. So he said, hey, a bullish trend is a series of higher highs, higher lows, higher highs, higher lows. And as long as that pattern continues, the uptrend is continuing. That's an important definition, because you get into a trade, you get some profit, and you start wondering, should I get out? Am I going to give it back? Is it going to turn into a loser? But if you just observe this pattern on a chart, what you know is, as long as, because price does not just move in a straight line, right? It does higher highs, higher lows. And once you learn this pattern, you'll see it on charts, and it can help you determine whether a trend has begun. It takes 3 data points: a high, higher, low, new high. That's the beginning of a trend. And it can tell you when it ends. Right here it is: high, higher, low, new high. That's the beginning of a bullish trend, right? And then a lower high doesn't put in a new high, takes out that prior low. The trend is over, right? And the same thing, it's the opposite on a bearish trend. Bearish trend is a series of lows, lower highs, lower lows, lower highs, lower lows. A bear trend begins with 3 data points: a low, lower high, new low, and it ends with a low, a lower high, higher low, new high. Bear trend's over. So if you have these rules, it really helps you in a couple ways. It can reduce the stress of wondering if the trend is still continuing. You got a definition of whether it is or not, and it can give you trade exit points, stops, right? Because you put your stops at these lows and you trail them up to the new lows, and you just let the trend run. So you can put in an initial stop, here, if this trend is beginning, and then as the thing moves, you can move your stop to here and to here, right? You take profit along the way. That's good trade management, but it really helps to just have an objective, black and white definition of a trend up and down. So that's Dow Theory, a portion of Dow Theory that I use here. All right, Ichimoku Cloud. I use Ichimoku Cloud. So how many people who are here, you can just type in a yes, or you can raise your hand. There's a little raise your hand button. How many of you think that moving averages matter in trading and on charts? There's a hand. Scott says yeah. Sergio says yes. Michael, Benjamin, Mark, lots of people. Lots of people. Absolutely. Ellen says yes. Okay, absolutely, moving averages matter. Now they're lagging. All all indicators lag, right? But they tell you something. Ichimoku Cloud is simply a different way of calculating and looking at moving averages. They use 3 periods. So a simple moving average, and I've got simple moving averages on my chart. We look here at target. This heavy white line is the 200-day moving average. It's the most popular indicator on the planet. Most traders who trade on daily charts have it. So if they're looking at it, I want to look at it. This lighter one, this light gray, is a 50-day moving average, so a little bit faster. Okay, 50-day moving average, and those are calculated. You know, the 200-day moving average, simple moving average, simply looks at the closing price, right, for the last 200 bars, takes the average, plots a dot, and then the next day plots another dot, another dot, another dot, and pretty soon you have a line made up of those dots, which is the average closing price of the last 200 periods, and then 51 is the last 50 periods. It's that simple. Okay, Ichimoku Cloud looks a little bit differently. They actually use 3 values, right? They have Tenkan Kaijun and then Senku span A and B, right? Which this one's, the A is derived from these 2, and this one's then a longer term one, right? So they have 3 variables moving from pretty fast to pretty long. And it's calculated rather than looking at the closing price of the last, you know, of the look back period. It's the average of the highest high, higher low, highest low in the look back period. So that's different. It looks at the extremes. And in simple moving averages, just looking at the close, it misses the extreme moves, right? Sometimes they can be big. So a little bit different look, and it ends up creating this shaded area, which is called kumo in Japanese, or cloud in English, right? And these are the medium, the really fast and the medium. The yellow is really fast, the purple is medium, Tenkan Kaijun. And the typical approach is, you know, when you get across fast over slow and prices above the cloud, that would be the entry for a long, right? I used to have these on my charts, and then I took them off because I realized it's axiomatic, right? If price goes above the cloud, you will always have a cross. So if that's true, I don't need to see it, right? Same thing going down. If price goes below the cloud, you will always have the fast crossing the slow. So you can see now I've modified, you know, my display of Ichimoku Cloud. I just showed the cloud because that's all I really need. And I've modified the settings. If you're looking at Ichimoku Cloud, like on Target or on S&P 500, you're going to see the cloud is different because I've modified the settings. I've optimized them in a way that I think is more accurate. So that Ichimoku Cloud. So and you can see the cloud also, not only does it confirm a trend change, right, as it goes above the cloud, it predicts and shows pretty accurately some support areas in an uptrend where price would come down to the cloud and then continue, and then in a downtrend, right, price goes up to the cloud, but the trend isn't ending until it really gets through it. So it's really helpful in analyzing charts. Terry says, "What's the numbers for your setup?" I'm gonna show you how you can get those, Terry, here at the end. All right, I also use a very simple, repeatable, easy, I'll try to think of some more adjectives for Elliott wave, because I know some people, some approaches to Elliott wave are ridiculously complex and subjective. Not interested in that. Again, I learned this from Bennett McDowell, a very simple, repeatable way to use Elliott wave to try and predict what's going to happen next, what's happening now and what's happening next. So it's interesting. Ralph Nelson Elliott was working on his Elliott wave thing back in the 1930s, which is the same time frame that Goichi Hasada was developing Ichimoku Cloud. So, you know, they were on different sides of the planet, basically, but working on 2 different analysis techniques that, it turns out, in my opinion, complement each other really well. So Elliott just said, hey, price seems to move in kind of natural sequences or waves, and it involves crowd psychology, where there's a big move, and as it begins, you know, there's a bunch of optimism and people join the trend, and at some point that sentiment, right, shifts from optimism to pessimism. There's some profit taking, and whatnot. And then there's a continuation. So there's an impulsive move. And after every impulsive move, and you'll see it on a chart, right? When you get a really, really big move, there is always a correction at some point in the opposite direction. And then quite often there is a continuation, right? So these are the ways we try and trade. You know, these are where the profit are, right? A big impulsive wave 3, a wave 4 correction, which can be harder, right? And we have ways of measuring how deep that'll go. We use Fibonacci retracements to predict with pretty good accuracy where that's going to go to. And then wave 5, a continuation to that original trend. Afterwards, there's typically a complex correction. That's very hard to trade. I just look, you know, with 10,000 stocks out there, I can trade wave 3, 4, or 5 and find plenty of good trade setups. And this thing works exactly the same on a bullish trend, which is depicted here, or on a bearish trend. You just flip it upside down. Right? So, and I trade both up and down. Sometimes the short trades can be the most dramatic. They move a little bit faster, it seems. Okay. Risk management, right? No matter what indicators you use, no matter what setups you use, or what your criteria is for entry, any trading system, you got to use risk management. And what that means is determining the maximum amount that you will allow a trade to lose if it fails. If you don't do that, right, you can go win 9 out of 10 trades, but if you don't control loss on the ones that go wrong, right, that one loser can wipe out the 9 winners, and over 10 trades, you could still end up with a net loss. And that's not the goal here, right? And I'm sure, you know, I certainly, before I learned this, had some big losers. And not only does it, you know, take a lot of money out of your account, it can be emotionally devastating. It can warp your perception of the market. It can make you, you know, either afraid to take the next trade, or it can make you angry and you try to go make it all back and then you lose more, right? Having a big losses is it's really bad, right? That's not the goal here. And we don't have to do that. We can go into a trade and understand and have decided ahead of time, right? If this trade goes wrong, what's the highest amount that I'm willing to lose, right? And you have to accept that some trades are going to fail and they're going to lose. And if you accept that, then you have to get serious about saying, if it loses, what's the most amount of money I'm willing to lose? And it needs to be an amount that is kind of pain-free, right? Pain-free level, right? I use 2% as the maximum. So if you had a $100,000 account, then that would be $2,000. The most I'm willing to lose on any given trade is $2,000. Now I don't want to lose that. I want to make money on a trade, right? But the most I'm willing to lose is $2,000. And in you know, times that are more unpredictable than others, right? When there's a lot of economic news coming out, or the market's getting choppy or whatever, right? I'll dial that back to 1%, right? So we figure that out by the first thing you do on a chart. When you look at a chart, is figure out, right? You're looking for a setup and you go, okay, here's where I'm going in. Where would I get out? Where would I get out, right? If I'm looking, let's pull up one of my my trades that I'm interested in. Use it as an example. I'll just pull the first one off my list here. Let's look at Caesar. And this is a short. Okay, Caesar's Entertainment, right? So I'm kind of interested in a short. I don't think it's ready yet, but let's assume it was, right? Let's zoom this out. Now we can see, right? We've had this move up, right? It's been in a long uptrend, had a little correction here. It's had this move up, but what's happening here? If you remember my discussion about Dow theory, right? Well, look, we had a low, lower high, and a new low. Well, by definition, that's the beginning of a downtrend, isn't it? Now we're still up above the cloud. The cloud is still really, really big, right? We're above the 50-day, we're above the 200-day, and my price oscillator is still positive. So this may be early, but you do have a sign that this trend could be changing. So let's just pretend that we were going to take this trade, right? Low, lower high, new low. I would put my stop here. One tick above that low, lower high, above that lower high. right? And then I would, obviously be taking my entry at current price. Now we don't know where it's going to open Monday, right? But say we were in the live market. If I were taking this trade, I would put my stop here. Why? Because of the definition of a downtrend, right? Low, lower high, new low, right? That's a downtrend. And we expect the downtrend to continue in this fashion. It's not going to go straight down, right? We expect a series of lower lows, lower highs. But what if we got a nice beginning here, but what if for some reason information changed, sentiment changed, it went up above here? That would mean that this downtrend has been invalidated. No longer a downtrend. Okay. Well, that's the point we want to exit. When the rules, the definition of a downtrend are violated, that's no longer a downtrend. All right. I want to exit the trade. So what we do is we calculate if this is my stop and if this is my entry, the difference 119.16, 110.80, right? That's about $8 and some change, $8 and some change. So if this trade fails, I'm going to lose about $8 a share. What I do is go, okay, if I'm willing to lose no more than $1,000, well, then I divide 8 into 1,000, and that'll give me the number of shares to trade, right? Because if I'm going to lose $8 and I go hit the stop and I get out of the trade, that's what I'm going to lose. And then to make that real, I actually have to exit the trade here, right? And absorb that loss. But it's a tolerable number. It's a tolerable number. And some people, they go, well, does that mean you put a stop market order in at this price, and don't the market makers see your order and they're like little gremlins out there trying to hit your stop? If you believe that, then don't put a stop order in, but put in an alert. All trading platforms and brokers have the capability where you'll get, a pop-up on your screen, or you get an email, or you get a text message, something, right? It says, hey, the price just hit your stop level. Then you go place your order, but do it, right? Do it right away. Okay. Or you can put in a stop limit order, whatever your preference is there, right? But the point is, you got to exit the trade when it hits that price to make that math real. And if you're trading options, what we do, we can predict, right? We have a simple method, just only buy premium, right? So that if you lose 100%, it would be at that 1 or 2% number. Or you can use an option calculator and calculate the option price at that stop level. Hope that makes sense. All right. So you got to use risk control. That was the whole point of that, right? And I demonstrated how I determine my stop on a chart using Dow theory, real price levels. Some people use what I call arbitrary stops, and I don't mean to offend anybody if you do this, but maybe I would convince you to think about another way, because some people go, okay, if the max I'm willing to lose is $500, then they put a fixed amount. I go in and I'm putting 10 grand into every trade, right? And if it draws down $500, I close the trade. Well, I would suggest that that's completely arbitrary. It's kind of like getting in your car and go, I'm going to drive exactly 1 mile and I'm going to make a hard left 90 degrees. Well, I hope there's road there, right? They're not going in the ditch, right? Because it's arbitrary. And if you look at the chart, right, like here's this downtrend for Caesars, this previous downtrend, right? Here. What you notice when you draw, and kind of put a channel on the downtrend is that, like I said, price doesn't move in straight lines. It's a sequence of lower lows, lower highs, lower lows. And there's an average true range for move, right? Price is going to move within some expected range in the downtrend. So if that's true, right? And if I go, $500 is my thing, right? And I go short, right here, right? That's not going to work here because this one was a marvelous trend. But the point is, you go short, right? and you draw down 500 bucks, you close the trade. That may have been within the absolute expected true range of the move, right? So what I'm suggesting is let's determine the stop price, which would be within the expected, true range of the move, and then determine the position size from that, so that we exit if that channel is broken, if the downtrend definition is broken, and at that point we would lose the max amount, right? Hope the difference makes sense to you guys, right? Because one is driven off of price action and the realities on the chart, and the other is, in my opinion, arbitrary. All right. Trade management, right? So you get into a great trade, you got great risk management, now you have to manage it. And that means taking profit at the right times, adding to the position when the criteria is met, staying with a winner as long as possible, exiting the trade at the right time, right? And so we just use the same thing. We use Dow theory, and we, like on this long trade, right? Here, we had this great, right here, high, higher low, new high. There's the entry. Wave 5 here. Here was wave 3, big impulsive move. Here's the correction to a Fibonacci level. Here's the next impulsive move up to a Fibonacci extension target, right? And now we got the criteria: high, higher low, new high above the Ichimoku Cloud. We take an entry. The initial stop was here. And now as this trend plays out, we move the stop to here, we move the stop to here, right? And along the way, we'll take profit, right? Let's take a third off, lock some in, take another third, and then let it run to the target, and until it finally hits your last stop, right? Anastasia is asking, how do I define my targets? I use Fibonacci extensions and retracements. So this Caesars trade, right? Let's look at a little bigger picture, and it's not really there yet, okay? But we would look at this move and see what a retracement on this move would look like. And so the sweet spot here is this Fibonacci 38.2 to 61.8. That's where we expect an impulsive move to retrace to. And then we look at support and resistance lines. We can say, wow, there was a lot of support here. So I would set my target right there in this zone at this support level. And then that gets to another point of reward to risk. We look at the difference between entry and stop, entry and target, okay? This has to be bigger. It has to be at least 1.2 to 1, preferably 2 or 3 or 4 or 5 to 1, right? The bigger the reward to risk, the better the trade, as long as the setup is good, okay? And FT Wong says some veteran pro trader coaches use alarms on the stop prices, right? So that market makers don't see your orders. I've talked to a handful of market makers. They think that's the funniest thing they've ever heard. But some people, if you're uncomfortable, that's fine. Yeah, you can just use an alert. And so, if you're uncomfortable putting a stop order out at your exit point, use a alert. But the point is, you got to close the trade. All right. So I reviewed that target trade. I think that was a great one, and we're looking for more, right? When I'm scanning for trades, we're going to get into it, right? First thing I do is ask, what's the big picture in the market right now, and just kind of stand back and think about what's going on, what could affect the market, what trend are we in, right? I create a thesis, and then I start narrowing a big list down to a manageable list, and then I have my trade setups, and I try to find some trades, right? With 10,000 publicly traded companies in the U.S. exchanges and all the ETFs, right? You gotta go target something, right? You gotta narrow that down, and there's several ways to do that. You can look at various sectors and see which sectors are performing either, lagging the market, maybe they're going to catch up, or they're leading the market up, or they're leading the market down. There's a variety of ways to do that. There's a really cool website I'll show you, free. Open a tab here, sector tracker. So this is the SPDR ETFs, right? All big ones. And various sectors, you know, financials, healthcare, technology, energy, right? And they got this kind of this heat map thing, which is super cool, right? And so that's 1 day. 1 day is pretty short time frame. Let's look at a week. You know, what were the strongest sectors? Oh, look, materials. What was the weakest sector? Communications. And from this, you could develop a thesis, and you go, oh, look, materials and real estate were super strong. Healthcare lagged. Maybe it's going to catch up. You know, you develop a thesis. Then you go, oh, I'm going to look at healthcare stocks, right? And then, you know, that's a thesis. It can be proven right or wrong. But you go, I'm going to look for healthcare stocks going along. Then you go look for your setup. So that directs your attention to a particular portion of the market. That's one way, is just using sector analysis. Another way is using indicators. And so I use the scanning features here, TradeStation. And I've got a scan defined that's pretty good. What I'm trying to look for is changes. Something that just crossed a major moving average, or it just crossed the Ichimoku Cloud, right, up or down. All right, so I scan the entire market. I do some filtering, make sure that it's a large company with liquid trading volume and all that kind of stuff. I filter out the penny stocks and the noise and the thinly traded stuff. Get the real companies, and then I go scanning. The scan is going to run. How many did it? No, it doesn't show me. You know, it ran on about 8,000 stocks, and goes, here are the 79 stocks, or something new happened. And now I can narrow my scan down, and I can go look at these on a chart, right? I can go, oh, look, here's something just crossed Ichimoku Cloud. This one's now below, this one's now above, this one's above, right? And I can look at which ones, when did it cross the 200-day moving average? 1 day ago. Well, that's new. That's something very new, 2 days ago, right? Now my focus has been narrowed. So I actually ran this, and I got a handful of candidates that I'll show you, because the actual process of going through that whole list is a little bit tedious. It doesn't take that long, but it's kind of boring. So I thought I'd just show you the good ones that I found. And then there's also, I use artificial intelligence software, which has intermarket correlation. So I ran a quick scan on that and identified some candidates. So here we go. Here's some of the shorts. So Caesars. This is what I call a watch list candidate. I want to see this develop a little bit more. This is a little early, right? But it looks like it's turning. So Caesars, that's a watch. Qdel. Okay, this could be a go right away, right? Because low, lower, high, low. It's below the Ichimoku Cloud. It's below the moving averages. We got negative momentum. This is pretty cool. And I can come up with, this is obviously an Elliott wave 3, big impulsive move, right? And so I can predict where this is going next using extensions. And because it's so low, right? It's because that's so dramatic. It's like, man, this has a target way down here. Now I also, just when I analyze a chart, right, I go, yeah, I got a target down here, which is sweet if that thing were actually to go there. But I also note that this thing's had support, really, really strong support at this level. So I go, I'll make that my intermediate target and kind of my worst case. I go, if it went no lower than that, would it still be a good trade? And here's stop's going to be here. My entry is going, oops, you want a vertical line. My entry is going to be here. Okay, how's my reward to risk? Well, this is bigger a little bit, right? If this opens way down on Monday, we'd be kind of chasing it. I look at, well, there's a potentially bigger target, but I'm going to be conservative, right? So I'll watch that on Monday. And if it is around this price level, that might be a good trade. So I'll put a star next to that one. And we'll look at that first thing Monday. CWH. So we got the same kind of thing. This one is breaking below the 200-day moving average more than it has in the past. We do have a low, lower, high, low, lower, high, low. So this looks kind of like a new trend beginning. There's not really an Elliott wave pattern here. So it's really tough to establish a target when we don't have prior impulsive moves. And you can see it just was kind of choppy. So it's got nice down momentum. And when you don't have a target, that can make it awkward. You can go look at prior support levels. And if you do, you see that it may stop there, it may support there. And that may not be a super good trade. And if we just take a mean, right, not much more to go. So that maybe that's not a candidate. CAG. All right, ConAgra. So big impulsive move down, a correction up, looks like it's heading down again, low, lower high, new low. So this looks like it has some room to the downside. Let's see what kind of target that would look like. Yeah, down in here, maybe. So that's a maybe. I like the QDEL better. A couple long trades came up in the AI. This is a HealthPeak, so I think it's a healthcare REIT. And you notice all these have good volume. I'm only interested in stuff that really has good trading volume. So we have big 3 up, perfect 4 correction. And by perfect, I'll show you what I mean. After you looked at 10,000 charts, you can kind of see what's going on. Your eye gets calibrated. But so this correction after a series of higher highs, higher lows, higher highs, higher lows, we had a really nice change in trend, right? Low, lower high, low, went below the cloud, momentum went negative. That's a real corrective move. And now in the short term, right? Now we had a little consolidation, high, higher low, new high. Now it's under the 50, still in the cloud. This is still red. So that's a watch list. We'll wait for price to get up here, really prove that trend's going, and then maybe. Visa. Potential long. Very similar, right? Big move up, nice correction. Looks like it could be starting. We'd let it get above the cloud up here and really prove that. Get green down here. EIX. So what, this is kind of a choppy channeling thing, but it does have a high, higher, low, new high. So if it breaks out, maybe it's not the best one. That was using the intermarket stuff. And Sergio is asking how much spacing between higher lows, lower lows. Yeah, really you're asking which ones matter. Is it the big moves or is it these little moves, right? Every chart's different. And you can look back at the history and see which ones really indicated a trend change. Like back here, this indicated a trend change, high, higher, low, new high, right? Some other little minor moves may not, right? So you just have to interpret the chart and develop an eye for it. Right? There is a bit of an art to the science. Couple long ideas here from that scan. I showed you this scan that I ran. So a long that came up here was HST. Hotels and resorts. So just what am I looking at? Why do I like this? Big impulsive move, really nice correction, new trend. Right. And it could have a really nice target using my extensions. Up here above 19. And you can see on Friday, price got above the moving averages above the cloud right there. A little doji looking thing. Right. We'll see how it does. That could be a great one. Great long. Twitter, of all things. It's in this wedge, right? Meaning price action is compressing. We'll draw it. Some people call that a banner or a flag, right? Looks like a college banner shape, kind of, right? Overall, big trend, a little consolidation. So when we see these wedges form, whichever way it breaks out is typically where it's going to go. So for a while. So if it breaks to the upside, it'll be above the cloud. So the Twitter's a good watch, right? We put an alert, let's check it out if price gets to about here. And these candidates, what I do is put them on a watch list, just a simple spreadsheet, right? List the trades that I'm interested in, what's the trigger price, what the comments are, got a little formula whether it was triggered or not, and then we come back and review it, keep an eye on this, and it's good just to have a list of trades. It's really rare to log in and go, oh wow, there's the perfect trade. Typically, we identify candidates that need to qualify, and then if they do, we go take the trade. Okay. There was a short that came up in that scan, Yeti. There's always candidates, right? Look here, Yeti. So this is a corrective wave, right? It had the big impulsive wave 3 up, clearly low, lower, high, low, lower, high. Now it's under the cloud. It's hitting it. It's reversing, right? Looks like it's going to bust through the 200. What is the target? We use Fibonacci retracements. Wow, this thing's got a target down here around $60, right? From 88. That one could be really good. All right. Put a star next to that one. All right, so those are some of the ones I found. And now I know you guys have some trades you'd like me to offer feedback on. So let me scroll back up. Some folks typed those in early. So Al wanted to look at Schwab. Let's look at Schwab. Okay. And if you got some you want to look at, type them into the chat. I'll get to as many as I can. Sometimes we run out of time because this is a popular thing. Schwab, Frau. Yeah, it's in a wave 5, right? 3 up. Here's our correction. It's taken off. So what's the target? And Al, you know how to do this. Right? You're just looking for validation. Al's been around a while. Target's up here, around 83, looking good, new highs. CTSH. CTSH. I wrote that one down, Al, because I liked it. Cognizant, big 3, very complex correction, started up. We do have, so this is really the first high. So I'm not convinced, and we got some resistance, some really strong resistance here. So I'm not excited about that one. Benjamin, ATAX. So this has potential, Benjamin. This is a watch list. The volume's a little bit thin. So the whole day on Friday was 222. So I would have to check that, right? Because I like it to have at least like 500,000 more. But what we got is a big wave 3, nice correction. And now we have the beginning, high, higher, low, new high. Let's get above the cloud and then above the 50-day moving average right here at about 635, 655. And if so, it could run up to, between 810 and 943. So that could be a nice one. And on these, you have to watch these, this is a triple top, right? 1, 2, 3 times it stalled there. So it could again, so you have to watch that. Sergio wanted to look at YS. Maybe he was saying yes. Back when I asked a question about moving averages. CZ, he'd like to know the wave count on CZ. I think maybe you meant Caesars when I was looking at Caesars, CZR. And Caesars is super clear, pretty easy. Now, I mean, it's 1, 2, 3, 4, 5. This looks like a new trend to the downside or the ABC correction. Danielle wants to look at Amazon. So, you know, Amazon obviously had this huge run up, and since then it has just been choppy. This is one of the hardest things to trade. Now you can trade the channel, right? Like the current channel, you just define the upper boundary and the lower boundary, pretty strong, right? And trade reversals from here, right? So it'd be a little late to go long, but if it reverses down, trade it down again, and you know it could do this. It could keep doing this until it breaks out. But it's not really like the setup I look for of impulsive or corrective waves. And then, you know, SPX. For the S&P 500, I like the SPY, so I'll look at that. So, you know, S&P 500 obviously has run up since, you know, a few months after the pandemic began. There is, you know, a trend change evidence, low, lower high, low. Now it just took that out. So it's like, okay, you know, we had a downtrend. It just went above that lower high. So we're at a real important decision point, right? It got below the 50-day moving average, right? And stayed below for the first time since last November. So we're at a really crucial point, right? If it reverses and heads down, we're probably going to the 200 or lower, or we could go on to new highs. So next few days are going to tell us that. So I would hold on trades on the SPY on the moment, right? Ray wants JAMF. Never heard of it. This could be the one. Okay. JAMF Corp. I know what it is, what to do. It's in an impulsive move. So here's the beginning. This is wave 1, 2. It's in 3. You don't want to chase impulsive moves. So it's been great. And, you know, it could double from here. Who knows? But we don't know, right? You can't put a target on an impulsive move. So what we do is we wait, right? Wait and see if we can get the correction or the continuation on the thing. So I just don't chase a trend like this because, again, it's unknown. It could stop at any moment. It's a nice trend, though. TTM for FT. Yeah, that's Tata Motors, right? Obviously some news coming out. And the thing's just a rocket. The same comment. I mean, it's so and it's tempting, right? Man, this thing's going to the moon. And it's tempting to go jump in, but I do not chase a linear trend like that because it will correct. And there's no way to predict when it will correct. And this is now wave 3. This had looked like 3, 4, 5. You could have gone long, you know, it turned into 3. That's okay. That's a fine way to be wrong. It went higher than predicted. I just don't chase these trends. You got to wait for it to correct and then see if there's a trade there later. Sergio, I'll do one for you because I've already did another one. I want to catch as many people as possible. KSS, Coles, you know, pretty clearly still correcting. Here's the big move up. It looked like it was going in 5, but then it failed, right? So now it's in 4, probably really close to the correction level. So yeah, it's in the correction zone. So you don't want to take that short. You know, you had this gap down, so you look, you know, it's not a great chart because the next move would be long, but you don't want to take a long into that gap. So yeah, you're welcome, Daniel. All right, TLT for Anthony. The bond ETF, long bond. So the big trend is down, big impulsive move. There's the correction. It's heading down again. So you don't want to go long here unless it really breaks out. Right. The target for this next move down is down here, and you would see, oh, look at this low. Right. So I'd put a target here. Wait for it to roll, get back down below the 200, and there could be a short entry on TLT down to here. All right. Well, we're almost an hour in. Hopefully you found that interesting. I came up with some, I think I got 5 or 6 trades here that I'm going to add to my watch list. And then Monday morning in the trading room, we're going to look at them and see how they open and maybe fire off some trades on those. So, like I said, finding great trade candidates, it can be like a needle in a haystack, but I think we found some good ones. And I wrote down the one from Al Schwab. So I appreciate that, Al. Remember this, you got to have great trade setups with a high probability outcome, great reward to risk ratio, risk management, trade management. You need all that, right? Do you believe having all that stuff will help make you a successful, profitable trader? We just type in a yes or a Y, raise your hand. There's a hand, Michael. Yeah. Scott. Yes. Anthony. Absolutely. I mean, hard to argue with, right? Bill. Absolutely. Right. How many of you are excited about some of the trades we looked at? I liked that Kidell, CAG, Yeti for a short. I liked Al Schwab for a long, HST long. Maybe a little bit unsure. Like, yeah, those trades look pretty good, but I'm not sure how to act on them. Or, you know, if you like options, it's like, well, how do I do that? How many of you feel like this guy? It's like, wow, that was a lot of information and I'm a little overwhelmed. Yeah, Ray, yeah, the recording link will be sent out in a couple hours, okay? So I mentioned earlier, hey, there's an offer here if you'd like to follow along, right? Remember, finding great trades is hard, and once you find them, you need a plan, right? You need risk management and all that stuff. So I offer some tools for that, right? I got some, you know, I've been doing this 6 years. The feedback I get from customers is really, really positive. If you want to read some of it, you can go onto my website. Go to the very bottom, down to the footer, and I got an A plus better business rating. And there are real customer reviews, and BBB does a great job. You know, they confirm that's a real customer before they'll post a review, right? And got really nice scores. You can go actually read those reviews from real customers. So, you know, what's it worth to have a service like this, right? You know, my average monthly return on a 100K account is $1,900, right? You get over 10 hours of detailed trade consultation per month in our trading room. You know, most services are going to charge you, you know, somewhere around $100 an hour or more. For one-on-one consultation, that can get really expensive, like $1,000 an hour. Ongoing education, you know, this adds up, right? You know, this stuff, if you were to go to, you know, an average trading service, right, it's about $5,300 if you were to buy that stuff individually, right? I'm going to offer you all this. Great trade setup, risk management, trade management, up to 10 hours of consultation in a group setting in our trading room. You get a one-on-one consultation, you get ongoing education and some tools for risk management and options and stuff, right? And access with, you know, the trades I'm trading. When you trade, it's not going to cost you $5,300, right? What it's going to cost you is a 30-day trial for $37. It's $97 a month after that, which is 25% discount off the list price. So, and it comes with a money back guarantee. I just, you know, I just believe in being transparent. And, you know, if you want to give this a try, that'd be awesome. And, but if it's not a good fit for you, you know, I don't want an unhappy customer. That's not good for me. It's not good for you. So, I just put a link in. You can try the thing for $37 for 30 days. After that, if you stay and you go, yeah, this is awesome, it's $97 a month. And, you know, during that 30 days, if you go, it's just not a good fit, right? 100% money back guarantee, no questions asked, no hard feelings. Okay. I just think that's the right way to do business. And the link is posted there in the chat box. Here's what you get. You get a watch list. I showed you, you know, the watch list, and we developed some more candidates for that. And we review it in the trading room. You get alerts via email, and I've got a dedicated app. So when I'm getting a new trade, you get an alert. Well, hey man, we're taking a trade. Here's the trade parameters. You get the exact details of the trade, entry, stop, target. Most of the trades can be traded with shares or options, your choice. I offer both ways to trade it. You get alerts when we're going to make a change. You're going to move the stop, take profit, close the trade, right? You get a alert either in email or in the app. You get access to the live trading room 30 minutes after the market opened. You can attend if you like. It is not required, right? We do record it. We have a recap, and you can attend. Some folks really enjoy it. Some folks, don't, or they don't have time. They got a job. You don't have to attend. It's optional. You will get the trade alerts no matter what. And we do an evening, midweek. Wednesday evenings, we do a live chat session, check in, answer questions, look at trades. You are offered a one-on-one consultation with me when you sign up. I just give you a link to my calendar. You can book it and just get to know you, answer any questions. I provide some tools for risk management and option trading. When you sign up, you get access to that. So you can have some tools to go through and figure out based on your account, how many shares or contracts to trade and follow my guidelines. And ongoing support and training. I get good feedback on the level of support and attention that I give my customers. You can see that in the reviews. I just think it's important. I think that's how you should run a business. And wait, there's more. I think someone had asked, I showed you my Ichimoku Cloud. I got unique setups, right? I have a course, my approach to Ichimoku Cloud, all my settings, how to set that up, how to interpret it, all that stuff. The course on my website is $247. If you sign up for the trial today, only during this session, right? So before we hang up, if you sign up and take the trial for the stock pick service, and there's the link again, I will include the Ichimoku Cloud course, no cost, only during this session. Questions? What do you guys think? We went through a lot of material, and I think we found some good trade candidates. So I'm going to go ahead and stop the recording, and that will be rendering. I'll send that out in a couple hours.